Hi, everyone. I'm actually going to be able to lecture a 2022 PowerPoint for Chapter 8. There are a few changes in our tax credits that we want to make sure that you're aware of that have actually happened in 2021. So, I've got to tell you, I didn't look in the book to see if they even updated for them. So shame on me. A lot of our credits are the same, but some of them, like our child and dependent care credit, has changed. So Chapter 8, let me go over to the PowerPoint itself. We're going to be looking at one more time how to determine a regular tax liability, how to compute what we call an alternative minimum tax liability. So that's something new. How we calculate a taxpayer's net investment income tax. And we've already looked at employment and self-employment taxes, but we'll review that. Then we're going to go into the tax credits. The first being the child tax credit, which is different for 2021. The child and dependent care credit, drastically different than the past. The education credits, American Opportunity and Lifetime Learning. And finally, the earned income credit. Now, those aren't all of the credits that are available for taxpayers, but those are generally the most common ones. And then in the last section, they talk about how we compute underpayment of taxes, late filing fees, and late payments. So let's get started. So we're going to move through this section very, very quickly because we have already looked at how to calculate regular tax and know that they're based on the progressive tax rate schedules at the back of our book and based on filing status. Again, our tax brackets are 10, 12, 22, 24, 32, 35, and 37. And they talk about what's called the marriage penalty or benefit, and that's something you could look at. There are some exceptions to our basic tax calculation, as we know, because certain items have preferred tax rates. Remember, our long-term capital gains are taxed at either 0, 15, or 20, dependent on our taxable income, and so are our qualified dividends, okay? Okay, so that was a quick review. I say go through the examples in the book, and if you have any questions, just let me know. I want to move on to new and fun stuff. So let's take a look at the first one. It's called the kiddie tax. Now, this tax has been around for a long time, and it's meant to tax parents who move assets into their children's names with the hope that their income from the asset will be taxed at a lower rate. For example, stocks, bonds, investments. So we're focused on not earned or unearned income, okay? So if a child, and we'll define who is a child for purposes of this tax, if their net unearned income is greater than $2,200, they may have to pay tax on that unearned income at the parent's rate. Oops. So who does this apply to? So if we have a child under the age of 18, automatically, if their unearned income is more than $2,200, this special tax applies. And it's just that the unearned income is taxed at a higher rate. Child is 18 at year end, but earned income is not greater than half of the child's support, or the child is between 18 and under 24, is a full-time student, and their earned income is not greater than half of their support. So they're not supporting themselves. So take a look. Assume Courtney's taxable income is $483,750. She has sorry about that. Let me skip ahead. We'll come back to that. This is with computing income tax. They threw the slides in the wrong way. All right, I'm going to take you into the book. We'll come back to Courtney here. To do the kiddie tax, go to page 8-6. Example 8.4. Suppose during 2021, Duran received $5,200 in interest from an IBM bond and $2,100 in interest income from a money market that his parents have been contributing to over the years. So they're in his name, okay? Remember the fruit and the tree. So this income is reported on his tax return. Is he potentially subject to the kiddie tax? So I'm assuming here, and I think we know this from prior examples, Duran is a dependent of his parents. He's under 18 or meets one of the qualifications. Now, okay, Duran is younger than 18 years old at the end of the year, and his net unearned income is greater than $2,200. Interest from the bond, interest from the money market, that equals $7,300. So how do we tax his unearned income? Well, we compute his income tax return as we always do. Put his interest income on the tax return. Now remember, when you have a dependent, their standard deduction is the greater of $1,100 or earned income plus, I think it's $350. He has no earned income, so his standard deduction is $1,100. So his taxable income is $6,200 in total. Now here's how the kiddie tax works. We say, okay, how much income was unearned? $7,300. Subtract $2,200 because it's the unearned income above $2,200 that is taxed at the parent's tax rate, their marginal tax rate. So $5,100 of the $6,200 is taxed at 24% because that is his parent's tax rate. It's given somewhere, okay? The remaining $1,100 of taxable income is taxed at his normal rate. So it is the unearned income. So if Duran here had some earned income, his earned income would be taxed at his normal tax rate based on his income. So in total here, $1,224 is the kiddie tax, the tax on the unearned income above $2,200. And the 110 is on his normal tax rate. So that would be the taxable income left after taxing the unearned income. So his total tax liability is $1,334. Okay, so you can take a look at another example at the top of page 87. All right, so let's take a look here at Courtney, just because the examples are here, just to remember how to compute income tax. So assume Courtney's taxable income is $43,750, including $15,000 of qualified dividends taxed at the preferential rate. What is her tax liability? So her taxable income, $43,750. Of that, $15,000 of it is taxed at preferential rates. So the amount that is subject to her normal ordinary tax rate is $468,750. Now, Courtney files head of household. If we go back to the tax rate schedules at the end of the chapter, head of household, taxable income between $468,000 and $750 means her tax is computed at $46,385 plus 35%. Her income is above $209,400. So that portion of her tax is $137,157.50. Now, if you're like, what's going on with the rest of this? How do we tax her $15,000? You're going to have to go back into chapter 7 for this. Remember where is that? It's on page 7-10. How do we tax her preferential income, that $15,000? Well, we go to head of household and we say, okay, if your taxable income is between $54,101 and $473,750, you use a 15% rate. But Courtney's in a unique situation because her taxable income is above $473,751. So when this happens, we go, okay, how much was taxed at ordinary rates? $468,750. How much more income would bring her up to $473,750? $5,000. So $5,000 of that $15,000 dividend is taxed at 15%. The excess above, bringing her taxable income above $473,751 or $10,000 is taxed at the next rate of 20%. So her total income tax would be $139,908. So that's how we deal with preferential taxed items. We be careful of that because some of the preferential rate may be at one rate, like 15%, the other could be at a higher rate. And that explains that in that slide there. All right, I know there's going to be a kitty tax example. So let me just see. There it is. Okay, so this is the Duran. Okay, and in this example, they tell us Duran's mother is subject to a 24% marginal tax rate. Remember, that's what her next dollar of income will be taxed at. And this was the computation we saw in the book. Okay, so we're cool there. Let's go back to this. Net investment income tax. I kind of shudder when I hear that, but let's take it to the page. Net investment income tax. It's on page 8-13. It's an additional tax assessed on net investment income of certain higher income individuals. And the way we calculated it is 3.8% of the tax imposed on the lesser of your net investment income. So a taxpayer will look and go, what's my net investment income? Interest, dividends, annuities, royalties, rents, passive activity income, net gains from disposing of property, less related allowed deductions, maybe an interest on our investment. We calculate that, or we then compare that to, so it's the lesser of the first, or the excess, your modified adjusted gross income is above $250,000 for a married filing joint, $125,000 for married filing separately, and $200,000 for all others. So if you go to page 8-13, we'll take a quick example here so you can see it. Courtney's AGI and modified AGI, Maggie, is $187,000. Her investment income consists of $321,000 of taxable income, $700 of dividends, $5,000 of rental. What is her net investment income tax? So this is an additional tax above her normal income tax. Well, her net investment income is $6,021, and you can see how they determine that. Her modified AGI is $225,000, which is above $200,000. So we impose that 3.8% tax on the lesser of the net investment income of $6,021, or the amount her Maggie is above $200,000. So in this case, it would be the $6,021. So she will have an additional tax of $229. And that's how we compute that. All right, I'm gonna roll down then to our next one, which is the alternative minimum tax, which is really like an oxymoron. It's not really a minimum tax. It's kind of like a maximum tax. So we are required to compute this. Once we complete a tax return before we file it, we are required to determine if our client may owe this additional tax. And here's how we compute it. We take taxable income right off the 1040. We add back the standard deduction if we took it on the tax return, on the original tax return. We add or subtract certain adjustments, and those adjustments, the common ones, are listed on 8-9. So if our taxpayer had tax exempt interest income, we add that for purposes of this calculation. If they deducted personal property and real estate taxes because they itemized, or state and local or sales tax for itemizing purposes, we have to add those back. They're not allowed for purposes of this computation. Certain depreciations, we have to recalculate depreciation for this purpose, and may need to compare what we did on our original tax return to this calculation for AMT purposes. We're not getting into that. If we needed to add a state income tax refund, we could subtract it for this purpose. And also there might be an adjustment for the gain or sale of equipment or property, which we're not going to get into the computations and the nitty-gritty there. We just want to make you aware of those. So we start with our taxable income from the 1040. We actually do this on a 6251. I think yes, it's on page 810. And there's a lot more adjustments than those 3 or 4 that we just talked about, but these are the most common ones. We add back the standard deduction if we took that. If we took itemized deductions, we have to add back our state income or sales tax we deducted to get to taxable income and any real property and personal property. We have to add in any tax exempt interest income that we didn't add for our regular taxable income. And if we added a state refund for regular taxable income, we could subtract it. Once we add and subtract those adjustments, we get to our alternative minimum taxable income. We then are allowed to deduct an exemption amount. They're listed on page 8-11, and it's based on filing status. And once our income gets to a certain level, that alternative minimum taxable income gets to a certain level, we phase out the exemption. We'll take a look at a quick example there. But once we subtract that exemption, if we are allowed to, we have what's called our tax base. Depending on how much that is, will depend on how we calculate the actual tax. And this is on page 8-12. The first $199,900 of AMT base, tax base for AMT, is taxed at 26%, and any amounts above that are taxed at 28%. Okay, and just so we know, for AMT purposes, for alternative minimum tax purposes, we are still allowed those preferential rates on our qualified dividends and long-term gains. So you need to factor that into the equation as well. Once we calculate that, that is what we call our tentative minimum tax. So if our regular tax is more than that, we just pay our regular tax. But if the tentative minimum tax is greater than our regular tax, then we have to pay the additional amount above our regular tax as what we call alternative minimum tax. Okay, so I know it's kind of crazy. And usually it's just higher income individuals who are exposed to this type of tax. But in recent years, we've seen more and more of middle America. So usually our tax software will do this automatically for us if we code information correctly. But we need to know that if our client is going to be assessed this tax, we need to make sure we calculate it. Okay, so that's the, all right, I talked about that. Okay. All right, we talked about those add back items, and we talked about the AMT exemption. Now, based on filing status, now here's where your exemption starts to phase out or gets reduced. So if you're married filing joint, your alternative minimum taxable income is at $1,047,200. So you can see this is quite high. And it gets reduced 25 cents for every dollar over the threshold. So once your alternative minimum taxable income reaches $1,505,600, you essentially have phased out or reduced that whole exemption. Here are the amounts for the other filing statuses. So let's take a look on page 8-11. Actually, we'll start with 8-9, page 8-9, example 8-5, Courtney again. So Courtney here is trying to determine her alternative minimum taxable income. Now, some of this information, remember, Courtney is your taxpayer through this whole book. So some of this information came from other chapters. But here essentially is how Courtney will proceed with calculating her alternative minimum taxable income, the first part. Start with her taxable income, and then she will add her tax-exempt interest income and add back the itemized deductions she took for taxes. She was required to include a state income tax refund, and you could see the examples there, and you could go back to those. So we could subtract that. It shouldn't be in that 145,070 for purposes of alternative minimum taxable income. So when we subtract that and add those other items, her alternative minimum taxable income, 155,150. Now, Courtney is head of household. She's way below the phase out starting point. So head of household, next page, page 811, she could deduct her full exemption of 73,600. Okay, so her alternative minimum tax base is 81,550. So the example below shows you how to phase out the exemption. And you could take a look at that one. Go to page 8-12. Now, how will Courtney figure out her tax? Now, remember, Courtney had some preferential rate income. So her dividends are still going to be taxed at the preferential rate, and so are both dividends. She only has one dividend, 700, I'm sorry. So 105 is her tax on her qualified dividends. The remaining 80,850 of AMT base is below that 199,900, so all of it will be taxed at 26%. So her tentative minimum tax is 21,126. The preferential dividends plus the 21,021. So for purposes of this calculation, her tentative minimum tax is 21,126. Her regular tax is 27,323. Since her regular tax is above the tentative minimum tax, she just pays the regular tax. It's when the tentative minimum tax is above the regular tax liability that we would have this additional alternative minimum tax added and would have to be paid. So that's alternative minimum tax in 5 minutes, okay? And I know it's weird, but it's just considered an additional tax. Some more additional taxes. Employment FICA taxes. Now, just to remind you, when it comes to Social Security and Medicare, when we are employees, we generally pay in half of the total required amount. We pay part in and our employer pays part in. So 6.2% on the first, I forget it off the top of my head. Where is it? 142. Actually, that's even higher, I think. I think they brought it up to 147,900. And I learned that at my tax seminar that I was at. So let's see. I think I wrote it down. Yeah, no, I didn't. All right. So for purposes in our book, it's 142,800 for 2021. There it is. And then 1.45% for Medicare tax, and then 0.9% additional Medicare tax. Yes, you have to pay an additional Medicare tax when your wages are above a certain amount. The employer matches it. Now, you notice this, it says multiple employers during the year. I don't know if they have one here or not. I don't think so. But I want to show you this. I'm going to stop sharing the PowerPoint because I think it's something really important that people don't, we don't generally cover it. And let me find us here and open up a Word document. And take a look at that. Okay. All right. So let's say you have taxpayer A works at company C from January 1st to June 15th. And their gross pay was $100,000. And they switch jobs. For the rest of the year, from June 16th through December 31st, they work at Company D and they earn another $100,000. Okay, so for 2021, their total wages would be $200,000. Now here's how Social Security works. Remember Social Security, you stop paying once you reach a certain level, and I already forget it, 142,800. So taxpayer A here pays $6,200 when they're working at their first job. Now, when you go to work at a new job, your employer doesn't go, well, how much did you make so far this year at your other job? No, they act like this is your first job of the year. And you will pay 6.2% on your first 142,800 at that job. So this employee, taxpayer A here, pays a total of, sorry about the line there, $12,400 in FICA, or Social Security, I should say. Why? Because they had multiple employers during the year. Now let's take a look at this. If taxpayer A worked at Company C all year and made $200,000 in gross pay, what would they have paid in Social Security tax? Well, 142,800 times 6.2%. Doesn't matter for Medicare, because Medicare isn't limited. You pay 1.45% no matter how much money you make. So if they stayed at the same employer, they would have stopped paying Social Security tax of 6.2% once they reached 142,800. So they ended, and they would have only paid in 88.54. So in a year when there's multiple employers, we don't go, oh, well, stinks to be you. You had multiple employers. They just took too much out. No, we say, well, how much should they have paid in? 88.54. How much did they pay in? They paid in too much, 12,400. Well, then the difference should be refunded to them, and it is. And I'll show you where that's at. $3,546 is refunded on the 1040. Okay, so you have to be careful of that when you're working on your taxpayers, especially if they have multiple jobs, and their multiple jobs cause their gross salary to be above that 142,800 or whatever the limit is for that year. Any excess they paid because of multiple employers is refunded to them. So let me grab the 1040 menu, and I'll show you where that, I think the 2021s are out, guys. Ooh, how exciting. Let's see. It's, oh no, it's not. I saw some drafts of them. That's probably what it was. This is, I think I have to go to a schedule. Give me a moment. I don't see it there. Let me see if it's on the schedule 3. Yes. So let me share that with you. First, you will report this amount on I'm going to share that, but that, okay. Oh, come on, you. Whoa, you don't want to see all that stuff, right? So let's go here. Let me do this, Delta window. Hopefully you see schedule 3, and it would go on line 10. Okay, and that's where we report excess Social Security tax withheld. Okay, so we don't talk a lot about it in our book, and there's no examples, but I just want to make sure you understand that. Okay, and if you weren't able to see that, then just grab your Schedule 3. Okay, let me go back to our PowerPoint. Where is it? No, Chrome tab. Oh, that's what I had to show you. There's the Chrome tab. Sorry about that. There we go. So now you can see that in here. Okay, let me just do this and see if I can stop sharing that and share my PowerPoint again. There we go. Okay. So when it comes to self-employed individuals, they pay the entire amount of FICA and Medicare, or Social Security and Medicare. They pay the employee portion and the employer portion. How is their tax calculated? It's based on their profits from their Schedule C, and first we multiply that by 92.35%. Then whatever's left, we apply the same criteria for Social Security. The first $142,800 is taxed at 12.4%, twice the 6.2, and then the entire amount is taxed at 2.9, 1.45% twice. So let's take a quick look on page 8-15. Let me see what I want to do here. Okay, page 8-17, take a look. Assume Courtney's only income for the year is her $18,000 in net self-employment income from consulting. What amount of self-employment tax and additional Medicare tax would Courtney be required to pay? Well, her self-employment tax would be $18,000 times 92.35%. It's that result that you then base the tax on. So 12.4% of that for Social Security, and then 2.9% of that for Medicare. Since her net earnings from self-employment are less than $200,000, she has no additional Medicare tax. Now, what if Courtney works and has a business? How do we calculate her Social Security? Take a look on page 8-19. Courtney received $162,800 in taxable compensation from a company and has $18,000 in self-employment. What are Courtney's self-employment taxes and additional Medicare taxes on her $18,000 of self-employment? Well, since her gross pay is above $142,800, none of the $18,000 would be subject to Social Security tax. So she's paid the full amount in she needs to. However, we'll take the $18,000 times 92.35%. That amount is subject to the 2.9% Medicare tax. So she still has to pay that on the self-employment income. Since the sum of taxpayers' compensation and net earnings from self-employment are $179,423, which is below the $200,000 for additional Medicare tax of 0.9%, she's in good shape. Okay, so we always take a look when we have a self-employed person who also works a job. We always take a look and go, wait a second, have they paid into Social Security yet, and on how much of their gross pay? And then if there's any amount that's still not taxed, that'll come from the profits. So there's a whole bunch of examples there. Take a look through them and let me know if you have any questions on those. And well, let's take a quick look at this. She has $100,000 of taxable comp from EWD, and she received $80,000 in self-employment. So let's see what her taxes will be. So of the $142,800 limit, $100,000 she's paid tax on already. So Social Security. So she still could pay $42,800. Her net earnings from self-employment subject to Social Security tax, or 166,230. So 42,800 will be the amount used to calculate the Social Security portion of self-employment tax. All 166,230 is used to calculate Medicare tax. Now, since her compensation and self-employment tax are above the 200,000, she will have additional Medicare tax on 0.9% of that excess amount, or 66,230. So once we add the 5307, the 4821, and the 596, there's Courtney's total self-employment tax. Okay, so we've seen this from a couple different perspectives. And actually, I think that brings me to a good ending point for this part of our discussion. I have to go teach class now. So this was part one. Read through employee versus independent contractor. This is very important in our tax world. The IRS auditors love to look at this to make sure people are being properly classified on businesses as either being employees or independent contractors. Independent contractors pay taxes, their own taxes, federal self-employment tax, etc. Employees only have to pay half of Social Security and Medicare and have federal tax withheld and don't have to worry about paying it in themselves like a self-employed individual. Okay, so that's it for part one, and I will see you back here for part two.